All right. Good morning, everyone. Welcome to this week's episode of DoubleLine Minutes. I'm Eric Dhall here with Mark Kimbrough.
Hey.
We're here on Friday, December 13th. Happy Friday-the-13th. Hopefully that's a lucky number for some of you. I'm not superstitious myself, so I'm going to say it's going to be a lucky day. And with that, we'll kind of dive right into where we are for the week. Pretty interesting week in the markets. From an equity perspective, a little on the sluggish side. You know, we had President-elect Donald Trump ring the bell at the New York Stock Exchange on Thursday and, maybe top tick the market because week to date, the S&P 500 is down 0.87% as we sit here speaking. Only two sectors are in the positive for the week, and those are consumer discretionary up 68 basis points and communication services up a mighty 2 basis points. The biggest lagger on the week was materials down 3.12%. Kind of down there in the basement with them was utilities down 2.5% as of the recording of this podcast. Now, when we look at some different ways of slicing the U.S. equity market, looking at growth, the Russell 1000 growth is down 12 basis points. And the Russell 1000 value was down 2%. So pretty big dispersion on the weekly basis between value and growth there. Looking at the small cap space, a little bit of pain. Russell 2000 down 2.9%. Moving over to bond land. In bond land, there was a little bit of pain as well. The U.S. aggregate bond index is down 1.4% on a week-to-date basis as we had rates back up with the 30-year U.S. Treasury backing up about 25 basis points. So that's a pretty significant move on a weekly basis. Not a huge move, but big enough to look at. One bright spot in fixed income was bank loans, up about 20 basis points on the week. And kind of looking at the other sectors there, high yield corporates were down 0.5%. Investment grade corporates with their longer interest rate exposure down 1.7%. Agency mortgages down 1.5%. Treasuries down 1.3%. And EM down 1.4%. So a little bit of pain there in bond land on the rate move. That said, looking at the dollar rallied, and dollar rallied 88 basis points on the week. For all the Bitcoin lovers out there, still above 100,000, above 101,000 actually. So Bitcoin's still chugging along. Commodities, another area of potential strength. The BCOM index was up 1.3% this week. Gold edged up 88 basis points. Crude oil saw some strength. Right now, crude oil is trading at $71, up over 5% on the week. So all in all, I'd say, a pretty lackluster week for traditional financial assets. But in the alternative space, like commodity and Bitcoin, there were some bright spots. What do you have to say, Mr. Kimbrough?
Yeah, I want to pick the superstitious baton. I want to pick that up from you because it's from my baseball days. This feels like a Friday-the-13th week to me. This weakness in our inflation week has been kind of a little rough. Like you said, a little choppy equity market on the downside and the bond market. Like one of the things you mentioned actually was the bank loans being like one of those sizable outside performers. Not to front run our talk later on work, but during this course of inflation week, we've had some data that seems to have kind of pulled a little more of the rate cutting cycle out of next year, and I'm assuming that fed right into our bank loan performance. So it's definitely an interesting week, but it seems like we had it was a modest slate of economic data, but important due to its inflation and that driving so much of what's going to happen with the Fed. But all in all, yeah, I like the summary for the week.
Yeah, I tend to agree with you. I mean, we're wrapping up the year here. Let's be realistic. And year to date, the equity market has had a tremendous run. Let's not just point out, oh, this was such a terrible thing. Year to date, the S&P 500 is up 28%, which is a fantastic year. So, and even in fixed income, you have positive returns on the U.S. aggregate of up 2% year to date. So I think that financial assets have done quite well. Just maybe we're kind of getting towards the end of the year. Perhaps there'll be a Santa Claus rally, but I'm not sure. I'm not
You
sure
know,
about that one.
on that note, this is an economic data point we talked, I want to say last week, but at least as of last week, I haven't checked to see if we've beaten it, but I think we've had 57 all-time highs on the S&P 500 this year. That just gives you a sign, as you say, the strength we've seen this year. So it's been a hell of a year.
Yeah, it has. And kind of let's jump into the macro, Mr. Kimbrough.
Let's do that. I'm going to skip ahead to Tuesday. We're going to start off with the NFIB Small Business Optimism Index. This is for the month of November. This came in at 101.7. That was 6.4 points higher than estimates and 8 points higher than the prior. In summary, this strong print, good print. I should say it's an improvement. It's the highest print we've seen since June of 2021. And for a little more context, it's actually the largest 2-month increase, rolling back to last month as well, that we've seen since the November to December 2016 period. So that may sound familiar. That's the last time we had an election back there with President Trump being elected. So just to speak to that a little bit, there's a chief economist at the NFIB speaks to this report in context of the small business owners. And he said that small business owners are being, and I quote, particularly hopeful for tax and regulation policies that favor strong economic growth, as well as relief from inflationary pressures. In addition, small business owners are eager to expand their operations, end quote. All in all, look, we don't take a lot of weight in these sentiment surveys, but you can't be upset with people being optimistic and that optimism being at multi-year highs. So small businesses are back with the economy, and hopefully this optimism actually turns into action. So we'll see what happens there. Moving forward, again, mentioned earlier, inflation week. On Wednesday, we had CPI for the month of November come out. Across the board, month over month, year over year, core and headline numbers, they all came in line with estimates. I'll give you a quick summary of the details here. You had headline month over month coming in at 0.3%. That was 0.1% higher than the prior. You had the core number, ex food and energy, coming in at 0.3%, right in line with the prior. You had the headline year over year number at 2.7%. That inched up from a prior 2.6%. And you have the ex food and energy year over year printing 3.3, right in line with the prior. At a headline level, this was the highest month over month print we had seen since April this year, but that's 1 month. I'd rather also focus on the core. So let me dive into some of those details here. We had core services, very significant, both topic of conversation as well as material impact in the CPI calculations. This continues to settle down. It increased to 0.28% month over month. That's below the pace we've seen over the last 12 months, so call that a little disinflation trend. On a year-over-year basis, core services are at 4.56% versus 1 year ago at 5.47%. So those are elevated numbers. There's a long way to go, but it is moving in the right direction. Digging within core services a little bit here, the shelter component, again, heavily talked about, heavily debated. This is 37% of the overall CPI basket. It did settle down this month, coming in at 34 bips month over month. This is versus, give a little historical context, an average of 24 bips that we saw in the pre-COVID era back through, going back to 2011. Since this 2021 to present, we'd averaged 46 bips. So we're kind of right in between where we were pre-COVID and where we were over the last 3.5 years, 4 years. So
I think that's an interesting data point. Kind of moved down halfway between, let's say the low inflation times and the high inflation times. So
indeed,
still wood to chop there, but progress has been made.
indeed, and it's a trend of progress. So hopefully that can continue. You can also staying with core goods. This has been a deflationary kind of level of support we've had for quite some time. This has helped the core goods. The core CPI numbers. It's helped with the disinflation we've seen. Unfortunately, this month we had a 0.31% month over month rise in the core goods metric. It's the highest since May of 2023 and makes for 3 months in a row of rising core goods prices. Not to overstate that, year over year, still negative 58 bips. Random fun facts.
That's kind of an interesting data point. I think
please.
I've heard the anecdotal stories of business owners out there trying to really stock up on goods from overseas before the new administration takes place or takes power in January because of tariff fears. And I don't know if that's related or if it's just a seasonal variability, but definitely something to keep an eye on there because that would be a potential. That's been an area of, let's say, um, inflation abating, that hasn't been pushing inflation higher that could potentially become a problem if prices go up.
Definitely agree with that logic. I mean, yeah, as a sudden impulse of an increase in demand as people are trying to race before year end, before the new year starts. Yeah, that makes complete sense. So thank you for the observation there. Adding on a fun fact to this day is something that Mr. Dhall and I talked about yesterday. Actually, there's four main components of CPI. You got the core portion, core goods, core services, and then you have food and energy, what's removed from core. This month you had food up 40 bips, energy up 20 bips, core goods up 31, and core services up 28. The observation there is it's a very tight grouping, and it's actually the tightest. It's the least amount of dispersion we've seen since June 2014. Not trying to draw any big conclusion from this, but it is nice to see that everything kind of is rowing in sync. Again, 1 month, but it was just an observation. It was interesting to see. Aside from that, you look at all this inflation is still with us. The year-over-year core metric over the next 5 months, we'll see an average roll off of 34 bits per month. So the bar is pretty low for that metric to try and make some more progress from the 3.3 it's currently at. Moving forward to Thursday, we had PPI come out for the month of November. These mostly came out stronger than expected. You had the headline final demand number month over month come out at 0.4. That was 0.2% higher than estimates, 0.1% higher than the prior. You have the X food and energy version month over month. That came out at 0.2%, right in line with estimates, and slightly below the prior of 0.3%. The year-over-year numbers, those ticked up. We had the year-over-year number come in at 3%. That was 0.4% over estimates and 0.4% over the prior. And lastly, the core, called the X food and energy year-over-year at 3.4%. 0.2 over estimates and right in line with the prior, thanks to a prior revision up. I'm not going to dwell too much on these. These are sitting at elevated levels, though. This was a market moving event, but this seems to influence the removal of some more of the rate cuts for next year. That half a rate cut we've kind of seen change week over week. You can just say that some inflationary pressures on the wholesale side upstream from consumers. So we'll see if that kind of ripples through into CPI later on. Also on Thursday, we had initial jobless claims for the week ending December 7th. Came in at 242K. That's 22K over estimates and 17K over the prior. Look, it's actually the highest print we've seen since October when we were talking about all the different storm impacts. But it's still relatively tame. I'm going to say it's 1 week. There's also a little influence potentially from the Thanksgiving week. There's talks of some distortions there. Also on Thursday, continuing claims for the weekend in November 30th. This came in at 1.886 million. That's 9K over estimates and 15K over the prior. This has been a gentle rising trend, and that trend continues. The 4-week moving average is inched up to 1.888 million. That is a new multi-year high. So again, the softening trend in labor continues, although it's a gentle trend.
Yeah, I mean, I think it's important to keep an eye on these numbers because there is cyclicality and volatility, but it's definitely higher than it has been. And if you're a bear, you're gonna really jump all over that and be like, maybe that's a crack right there. We'll have to see what happens. I feel like this is there's you have to see how this evolves over time, but it's not positive.
Yeah, it's corroborated with what we see in the establishment and the household survey data. This is just that more high frequency data we get to help us assess. And then finally on Friday, we get import prices today. Those came in higher than estimates. On the month over month figure, you were 0.1% versus 0.3% on the, you had 0.1%, 3.3% over estimates. That's right in line with the prior. The import prices, month over month ex petroleum, right in line with the prior at 0.2%. And the year-over-year numbers at 1.3%. That was slightly ahead of the estimates and 0.7% ahead of the prior. That's a big jump month over month on the year-over-year numbers. You have a quick explanation. Base effects. We lost negative 0.5% this month in the calculation, and we rolled on to 0.1. So there's your, add those together, a little rounding, and there's your 0.6. Over, that. over the past 7 months, we've had an aggregate though increase in month-over-month CPI of a negative 0.4%. So I don't want to say like we have any sort of bubbling up inflation impacts in the import prices though. So this is something that can help with the disinflation effort as long as these numbers can stay contained, and hopefully in the new year we start dipping down further. And that wraps up this week's economic data.
Yeah, I think that was pretty comprehensive. I mean, numbers came in line with expectations, maybe a little hotter. You saw like the market maybe not burst to a new high. We had equities sell off, we had rates sell off a bit. We had the kind of the the future Fed cuts that are being kind of speculated on in the market drop. Though the Fed meeting next week, there's a 97% chance of a cut as of this conversation. And
Call that a lock.
yeah, we'll call that pretty much a lock. But we're only seeing 2 cuts in 2025 right now, so that's a bit of an adjustment.
Yeah, you got to
Now
process
that
those that come in.
Yeah, that brings us to the topic of the week. And so one of our listeners, Rich, sent us an email, and Rich said, "Hey, the CPI just came in, hitting expectations. However, the headline was the hottest since April. Mr. Gumlock has stated in past interviews that DoubleLine models predict CPI heading back to 2% or even below in 2025. Has the recent data changed this prediction? All the talking heads are saying sticky, sticky." So, I think that DoubleLine's inflation model is still predicting a 2-handle CPI if energy prices stay contained. But energy prices are really the backbone of the entire economy, right? Even if you buy 2 apples at the grocery store, that required energy to get to the grocery store, energy to stay cool. So, in energy, CPI is very sensitive to energy inputs, even the X energy parts of CPI. So that said, you know, I the new administration has a philosophy or a purported philosophy of drill, baby, drill. Now, U.S. oil production is almost at all-time highs right now. So how much more can you really extract? That's going to be a question. I think it's fair to say U.S. oil production is not going to be going down. And given recent events with OPEC Plus, I also think that there's going to be likely a a ceiling on crude oil prices. So, for example, if WTI were to go up $20 next year, that would push CPI up, and it would be sticky or growing. You'd see it at a 3-handle potentially, maybe even higher. I don't really see that scenario being as likely given the current backdrop in the United States and with OPEC Plus. So if oil stays where it's at or drops a little bit, we definitely still think that we're going to see 2 handles on CPI next year. All that, though, is highly dependent on the macroeconomic environment, and tariffs could change that. A geopolitical shock could change that. So you got to keep your eye on the ball there. But big picture, I don't think we're predicting, based on this latest report, a massive change in our outlook. What do you think, Mr. Kimbrough?
I think you wrapped up quite nicely. I don't have much to add on that, actually. I'm pretty aligned there. It's hopefully low 2s and we'll make some progress, but it's the long grind on the disinflation effort.
Yeah, so we'll see what happens, but let's move on to the week ahead.
All right, let's see. Not too crazy of a week. Actually, no, there's decent data here. We start off Monday with S&P Global. This is the U.S. manufacturing. Actually, I want to clarify here. S&P Global is the entity. We're speaking to U.S. numbers here. We have U.S. manufacturing PMI coming out on Monday. That is for December. It's estimated to come in at 49.8. That's slightly above the prior 49.7. And you have the U.S. services PMI estimated to come out at 55.9 versus a prior 56.1. So slight degradation there. Not much changing here. This is the ongoing weakness for manufacturing and ongoing resilience/strength for services. On Tuesday, we get retail sales, get the advanced month-over-month number for November, the ex-auto and gas, and the control group. These are estimated to come in as an improvement from last month. We got 0.5% on the headline versus a prior of 0.4. We got 0.4% on the ex-auto and gas versus a prior of 0.1. And 0.4% on the control group versus a prior of negative 0.1%. In general, those numbers, even with last month's weakness, they've remained pretty firm on a 6-month annualized basis. I'm going to go in that same order. You got 4.66%, 5.85%, and 5.23% respectively. So these are all real actual spending. It's these are nominal numbers, but they're in excess of inflation. Also on Tuesday, we get some manufacturing data. This stuff has remained perpetually weak. I'm not going to dig too much into it, but I'll mention capacity utilization for November is estimated to improve to 77.3% from I think it's the multi-year low at 77.1. It's the lowest we've seen since April 21. So again, just ongoing struggles in manufacturing. We're waiting for that thaw. On Wednesday, we get the big day, the FOMC rate decision, where we're anticipating a cut of 25 basis points. We're also due for another summary of economic projections to get released. So we'll see how the Fed is setting things up or how they're seeing the world heading into 2025. On Thursday, you get the third estimate for GDP for the third quarter. No fireworks expected. We got 2.8% as the estimate, and that's exactly what we had in the second estimate. Also on Thursday, you get the standard initial and continuing claims. Last I looked, I didn't see any estimates, but we'll see if the gentle trend out continues. Also, you get on Thursday the leading economic index for November. It's estimated to come at a negative 0.1. Getting frustrated with this metric. We're just going to leave it there. On Friday, you got personal income and spending for the month of November. Those are estimated to come in at 0.4% for income. That's 0.2% below the prior. And spending is estimated to come in at 0.5%. That's 0.1% above the prior. Both these numbers have remained firm. Got year-over-year income last month was at 5.3%, spending at 5.4%. Again, just like real retail sales, these are nominal figures, but they are real growth in actual income and spending relative to inflation. Which brings us to Friday, the final data points, that is inflation, that is PCE. These estimates are generally extremely accurate at this point in the month, after we've received all the CPI, PPI, import prices, and whatnot. The headline PCE number month over month for November is estimated to come in at 0.2%, right in line with the prior. The month over month core number is expected to come in at, again, 0.2%. That's slightly below the prior 0.3%. This brings the year over year headline number to 2.5, an increase from the prior at 2.3. And the core PCE year over year number is estimated to come in at 2.9%. That is a slight increase from the prior at 2.8. Real quick, the next 2 months, the November and the December prints, we have very small roll-offs. Be very likely, it seems like, in the trend we've had in core PCE, to see a little inch up in the year over year number. We have 0.09 rolling off this month, 0.18% rolling off in December. But the good news is after that, again, the base effects, but they are what they are. We have the first 4 months of 2025 where we average a roll-off of 33 bips per month, starting off with a big 50 bips in January. So rattle off a lot of numbers there, but the point of it is we should be, at least the bar for core PCE year over year to come down should be a bit lower to start the year next year, which, would be a nice way to start the year.
Yeah, I think that's a good point, and it also kind of ties back in with our topic of the week. Those roll-off effects are one of the things underlying the likelihood of lower inflation, barring no huge shifts, which obviously can happen and are more likely to happen given the change in politics that's going to occur next year. But once again, we'll keep you updated. We'll dig into the details and make sure all of our listeners know what's going on. And that wraps it up for the week.
Thanks to all listeners out there today on DL Minutes. Hit us up on the X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
You can find more information about DoubleLine on our website, doubleline.com. Don't forget to subscribe to our YouTube channel at youtube.com/DoubleLine Capital. Thanks for tuning in, and I hope everyone has a great weekend in this holiday season.
Thanks to everyone out there, and be safe. Happy holidays.
This presentation was recorded on the date indicated. Views and opinions expressed herein are those of the individual and do not necessarily reflect the views of DoubleLine Capital